What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today just wanted to give you a brief update on what Powell said today, specifically because it really highlights that at least from what he's saying, and at least from public comments, it looks like they're absolutely clueless about what's coming. So in this video, we're going to dive into a couple of key points that Jerome Powell today in his speech was really focusing on hammering home, and why that highlights that it looks like they don't know what's coming down the road and what their likely response is going to be when this thing blows up. Ready? Let's dive in. All right, guys. So number one, one of the things that Powell mentioned more than once, like many times throughout the interview today, was that he was saying that they're trying to get inflation higher, and they have no plans of raising rates in order to rein that in, because he expects that if inflation hits 2, 3, 4%, that will be a very short term. It'll go back down. That's what transitory inflation means, that it's just short term, and it'll work itself out. And he's only expecting that if that shows up in the CPI, it'll only be there because of economic reopening, recovery, people getting back to work, people getting back to spending things, and things will normalize. The problem with that is that the market doesn't believe him. That's why rates spiked as soon as he started talking today. In fact, I'll pull him up just as we speak here, as I'm talking. Current 2-year Treasury is at 0.14%, which is up 1.28% just today. The 10-year is at 1.54%, which is up 5% today. And the 30-year is at 2.3%, which is up 2% today. Just on his remarks here, basically, the market wasn't looking for Powell to come out and say, hey, if inflation spikes, we're not going to raise rates. What they were expecting Powell to allude to somewhat is that, hey, rates have been going up in expectations that inflation is going to hit. Therefore, we are going to do something about the increase in rates. And the fact that he said nothing about that really indicates that, number one, either they don't think this recent spike in rates is in any way indicative of what's going to come in the next couple of weeks, couple of months in terms of rates. And if they did, they would have said something about trying to stop it, increasing their bond purchases mainly, simply because the market can't handle higher interest rates. And that's why you also saw the stock market start to sell off today as well. Now, the reason why it looks like they have no idea what's coming is simply because the only thing that he was really kind of hammering home was the fact that they are not planning on raising interest rates. And even when he was asked the very specific questions about the recent turbulence in the credit markets, especially with the longer term bond yields increasing, he really said, we don't look at just one indicator, just one asset price, is what he said. He was talking about, the yields of the long end bonds. He was saying, we don't just look at one thing, we look at a lot of things. And ultimately our goal right now is getting inflation up and getting employment up. And quite honestly, he mentioned a couple of times that what they would be concerned about is if they started to see tightening in the credit markets, a lack of liquidity and turbulence, weird things starting to happen. Well, this is why it looks like he's clueless, because last night the repo market blew up again. And if you remember back in September 2019, repo market blew up. It went, the repo rates spiked, but this time repo rates actually dropped. And so there's weird things. There's unexpected things that are not supposed to happen that are starting to pop up and crop up in the credit markets, and that's bleeding over into equity markets. And so that's why the market sold off today, because really people were expecting Powell to come out and say something a little bit more about, hey, we're going to buy more debt. Hey, we're going to increase our asset purchases. We're going to print a little bit more money. And so it looks like, if they're aware, and this isn't completely, just if the Fed is not 100% reactive and they're trying to look forward at all and, try and get ahead of some of these problems that look like they're on their way. If that's the case, then it's possible that the market, and especially the federal government, has some room to run with how high rates can get before it becomes kind of an emergency. So we'll see, but that is a brief explanation on why Powell's remarks today caused bonds to sell off, which caused rates to spike. Same thing. And then also caused the stock market to sell off as well. Now, specifically gold and silver, gold sold off. And the reason for that is because it's the inverse of real rates. When real rates go up, gold goes down, especially short term. They're very tightly correlated. And so the fact that you saw interest rates spike means that that's real yields spiking, because you're not going to have short-term inflation numbers or inflation expectations change that rapidly. And so when real yields go up, gold goes down. And so it's only a matter of time before this thing reverses, before they put a lid on how high rates go. And if you're interested in a deeper explanation of why, go watch my last video explaining the relationship between bonds and yields, and what supply and demand does to those, and why the Federal Reserve stepping in with yield curve control and Operation Twist is going to be what they'll have to do to respond to this, and the likely outcome of that. So as always, thanks so much for watching. Have a good day.